For more on the markets now, helping us break it all down, Jeff Small, president of Arbor Financial. Jeff, great to have you with us. The Dow dropping back below 26,000 today, and the 10-year Treasury also taking a dip. So does this raise real concerns about the state of the economy? What do you think?
Well, I think it really does. I think the smart money is starting to de-risk their portfolios. And to be honest with you, I'm really tired of all the talking heads say that stocks are still a better value than bonds. Nothing could be further than the truth at this stage of the market.
And so when you're looking at the broader markets right now, clearly there's something that is catching your attention the most, even in spite of all of the tensions on the trade front, policy fronts for interest rates as well. Where are you placing a lot of your attention, a lot of your money?
Well, today we're really focused on dividends and things that generate rates of income through yields. Some things that are not market specific. We like bonds. Of course, we like bond-like instruments at this stage of the cycle. We think that's the safest bet. But nobody should be surprised. You know, we're at late stage of the end of the bull market here. The markets just don't go up forever.
Yeah, and Bank of America, or rather Goldman Sachs, actually said that they have now growing concerns about a recession coming now within the next 2 years. Are you of the same mindset?
Well, I think the recession, it's going to be really hard for us to get below 0% GDP for 2 consecutive quarters. I think we'll get close to that number, but there's no doubt the economy is moderating. We are at a peak at this stage. China trade tariffs, negative trajectory on corporate earnings. Those are all things that are starting to wear on the market. And so the markets are still at all-time peaks or close to the peaks. And so nobody should be surprised about the volatility going forward. Late stage, moderating economy, China trade problems.
You know, as we've made it largely through the weight of earnings season, are you satisfied with what companies reported, where we saw results come in, and especially when the forecast going into it was pretty bleak?
You know, it really was. We were all relatively surprised that that bleak forecast, of course, didn't come to fruition. We expected it to be in that range. But, we still are expecting and anticipating negative earnings trajectory. And so when the trajectory changes and there's a China trade deal that's positive, then we'll see the market begin to recover. But until those two things happen, investors should be defensive. They should take some money off the table and sit this one out for a little bit of time.
Okay, and I know we talked a little bit about the factors leading to today's declines, but is it unusual to see 2 Mondays sort of in a row, back-to-back weeks where we have this kind of activity?
Well, I think it is. I think that the China trade deals and the drop in yields on the long-term rates are really making the markets unsettled. We all know, we're market historians, we're economic historians, what happens when there's a yield curve inversion. And the average time from inversion, the last 11 times it's happened since 1950, 11 times there's been a recession, 11 for 11, and it's happened on an average of 14 months post that yield curve inversion. And so some way, somehow, the Fed thinks it can save itself, but I seriously doubt the Fed can do anything at this stage. The market is going to moderate. The economy is going to start moderating even more.
So you think the Fed's actions are too little too late at this point?
I don't think the Fed has any ability to save the markets or keep the expansion going. I think the last several times the Fed has decided to decline rates or reduce rates in a growing economy, the economy is always tanked. And so we've seen a $1.2 trillion exit in equity funds the last 12 months. And so, as I said earlier, the smart money is starting to de-risk and become defensive at this stage.
And where do you see them de-risking to? Which sectors specifically?
Well, obviously, the bonds have had much more inflows than the equity inflows have been the last year, especially the last 6 months and especially the last 90 days. So folks are starting to gravitate towards more bond funds, but we like individual bonds and things that pay fixed rates of interest, bond and bond-like instruments.
When you think of the currency battles that we had seen, or the newest part of the trade war, if you will, what was your takeaway from early last week? How that impacted the markets? What we should expect from here on a go-forward basis?
Well, China wants to. They're in this misery loves company phase, and so they're trying to make everybody miserable by devaluing their currency and playing to their unfair predatory economic advantages that they don't want to give up. It's a brief rattle of the markets. Is it going to affect the $820 billion trade surplus that we have with them this year? Is it going to impact the $180 billion we're exporting to them this year? Not really. It just gives them a bigger economic advantage. So it's a very short-term effect. How much more can they devalue their currency, really, at this stage?
I want to go back to the Fed for a second, and I know you've already said that you don't think the Fed can save the economy, but we do know that given the last comments coming from Chairman Powell, that they would look at the situation and factor in the trade war, and if it got worse, they might, I mean, they didn't say that, but people are reading into it like maybe it's still a tool that they didn't cut too much, that they could cut then further. So you don't think if that there were like 2 more cuts this year that this would actually do anything for the economy?
Rates have dropped more than 2 possible rate cuts in the future by the Fed already in the last 60 days, and here we are. I don't see the Fed having any power with rates. Rates are already incredibly low. It's a feel-good for the economy. The economy is still fairly strong. Employment is strong. Consumers are very strong. So there still are some bright spots. At this point, I think the Fed really is kind of benign.
What if consumers are looking out for another rate cut in the future and they don't get it? Or what if we get more than we expect? Ultimately consumers, let me say on the side of if we don't get another cut, because for consumers, if they are trying to wait to have some of these big purchases, we were talking about the housing market earlier and how that might be impacted as a result of yet another rate cut later on down the line. If we don't get that, what do you think happens to the mindset of the consumer?
I don't think anything happens to the mindset of the consumer as rates go down. I think everything is based right now on corporate earnings and a China trade deal as far as the market's going. But if rates do drop, I think that's good for the consumer. Energy has fallen dramatically, so we've put, energy prices are dropping. That's also good for the consumer. And wages are rising. That's good for the consumer. And when we're at full employment, we have more jobs than people working they're unemployed right now that are available. So it's a phenomenal time in our economy. It should be getting more attention. But these are also indicators of a late cycle economic bull run.
Last question here, Jeff. We've seen negative rates in Germany, let's say, Japan as well. Will we see them here in the U.S.?
I think anything is possible. There's 14 trillion of negative government debt globally. Of course, that's non-domestic. Will the Fed play that card at some point? Geez, anything is possible. I do think that rates are going to zero. I've been saying that for the last 12 months. The global banks have already said they're going to zero next year. We will have to go to zero starting in 2021 to basically print up more money than we collect and keep the debt service serviceable.
All right, Jeff Small, president of Arbor Financial, joining us here today. Jeff, appreciate the time and insights.
Thank you so much.